Your bank is taking hundreds of dollars from your pocket every year, not because you're bad with money, but because it has spent billions engineering every product around your psychology. Here are 3 ways to fight back. Here's a scenario I'm sure you can relate to. You get a $1,200 tax refund in April, and you treat it differently than a regular paycheck. It feels like extra money, almost like finding cash in an old coat pocket, so you're more likely to drop it on something you'd never usually spend on, like a trip or a splurge you've been putting off. But your tax refund isn't a gift, it's your own money. You overpaid all year, the government held it interest-free, and you finally got it back. If that same $1,200 had shown up as an extra $100 every month, you'd have used it completely differently, even though they're the same exact dollars. While studying for the CFP exam, I learned that's called mental accounting, treating money differently based on where it came from. Banks exploit this all the time through credit card sign-up bonuses. Spend $3,000 in 3 months and get $200 back. You look at the $200 as free money, but don't pay attention to the increased spending and 24% APR. Banks know this, so they advertise big sign-up bonuses while keeping the rest in the fine print. Here's the fix. Before signing up for any card, calculate whether you'd spend that $3,000 in 3 months anyway on normal expenses like groceries or gas. If yes, the bonus is genuinely free money, but set a hard rule that every dollar of bonus money goes straight to savings or debt repayment, not a splurge, because it's still real money. And always pay the balance in full every month, because the interest can wipe out your $200 bonus entirely. By the way, if this video is helping you, please like and subscribe. It helps more people find practical money management tips like these. I passed the CFP exam at 16 and have helped millions improve their finances, and one of the craziest things I've learned is that most people, if given the choice between $50 right now and $100 in exactly 1 year, would take the 50. A guaranteed 100% return in just 12 months beats every reasonable investment on Earth, but we still want the money now. That pull toward right now has a name, present bias, and banks have built entire product lines around it. The clearest example is buy now, pay later. Companies advertise making just 4 easy payments, and your brain only considers the first payment, not the total. You feel like you're spending just $20 when you're actually spending $80. The pain of the full price gets pushed far enough out that it barely even registers. Here is a practical move to fight back. Before you split anything into 4 easy payments, write down the full price, not just each installment, and then wait at least 48 hours. You aren't denying yourself the purchase, you're just giving yourself time to consider the full cost. You'd be surprised how often you don't even want to buy the thing anymore. The next part is worth your full attention because it might be the most expensive thing you're overlooking. When you open a checking account, almost every bank offers something called overdraft protection. Notice how they frame it, protection. It sounds like a feature, like a seatbelt or insurance. Here's what it actually is. When your account hits 0 and you tap your debit card at a coffee shop, or a small subscription charge comes through, the bank covers it, and then charges a $25 to $35 fee for the protection every single time. Say you've got $5 in your account, but forget and spend $6 on coffee. The bank covers the $1 shortfall, but then bills you $30 on top of it for the overdraft protection. You just paid an extra $30 for the $1 shortfall. And it gets even worse. Some banks process bigger transactions before smaller ones, regardless of the actual order in which they happen. Picture this. you have $50. You spend $10 at lunch and $15 on gas during the day, and that evening, a $60 subscription charge hits. Logically, the $10 and $15 charges should go through, and only the $60 one should bounce. But if the bank processes the $60 one first, your account goes negative immediately, causing an overdraft, and now the $10 and $15 purchases are also overdrafts. You end up getting hit with 3 separate overdraft fees instead of just one. Regulatory pressure has made this less common, but it still happens. Most people never push back because the framing works. Paying for protection doesn't sound like a fee, it sounds like a service. But if you look closer, it's actually a loan with a $30 charge that you never asked for. So go into your account settings right now, or call your bank, and opt out of overdraft protection. When you do that, your debit card or ATM just declines if you're out of funds, which is mildly awkward in the moment, but costs you nothing. And set a low balance alert at $50 or $100 so you get a heads up before you're anywhere near zero. Another option is to go with an online-only bank, since they'd either cut overdraft fees entirely or just charge way less than the big traditional banks. But banks aren't the only ones who take advantage of your psychology. Credit card companies do this too. Watch this video to avoid 7 costly credit card mistakes and save thousands.